Use code JACK250 to get $250 off to the Blockworks Digital Asset Summit. It's in New York in September, and ticket prices are only going up. Link is in the description. I am joined by Paul Latronica, Managing Director and Portfolio Manager at Advent Capital. Paul, great to have you on for guidance.
Hey, Jack. Thanks for having me on. It's a really pleasure to be here.
The pleasure is all mine, Paul. You are an expert in convertible bonds. That is a part of the market I don't think is well understood by a lot of people, and it can be superficially complex. But I think that it's what goes on in that market really sort of reverberates throughout every part of the market, because it's fixed income as well as equity. So when rates go down and equity prices go up, convertible bond prices and their values and what's going on there is being affected by both sides of sort of the stack. So they're sort of in the middle between fixed income and equity. Briefly explain what a convertible bond is, and in what way do they differ than stocks and bonds, and sort of, how do they trade as well?
Sure. And a lot of things you said is absolutely true. Converts are kind of a derivative product because they have both, aspects of debt as well as equity. So if you break it down, what a convertible bond truly is, it's debt of a company. A company issues it into the marketplace. It pays coupon semi-annually like any other piece of straight debt, and it has a set maturity. The only difference is when this security is issued into the marketplace, for reasons that why people issue converts for those reasons. The company is willing to give the investor, a certain fixed amount of common stock, right? So in the life of that bond, the pricing or the valuation gets influenced at certain points by either the equity value, the option value, or the fixed income value, right? So convertible bonds can be very different characteristic-wise, depending on where the equity is trading at any one point relative to where it's issued. So if you think about options and how options work, right? A bond is issued and has a strike price of like a $35 strike price on an option, and the stock is trading at 30, right? It doesn't have that much, it has correlation to the underlying equity, but it's not like a one-for-one correlation. So if that equity price is to move higher, go through that strike and move up the curve and say trade at $40 or $50, now that equity option is in the money and it trades one-for-one with the underlying stock. So if you think about convertible bonds, depending on where that option is, right, the characteristics are extremely different. So an out-of-the-money option, the bond is more influenced by the fixed income value, right? What's the yield to maturity of a double B industrial company or double B tech company for 3 years out? So that bond will trade to a discount to par with a yield. Conversely, that stock is moving higher up the chain, and now this equity option is through the strike and in the money. Now this bond is going to trade highly correlated. The word delta, the correlation to the underlying equity, will have a very higher delta and be much more correlated to the underlying equity moves, right? So that would have more equity characteristics. So one of the confusing things that people have, or confusing things about the market, is how do you treat a bond or convertible bond? You can't treat them all the same way because the risk characteristics are very different, just depending on what point of the curve that option is sitting. So strip it out, basic, it's straight debt, pays a coupon, has a maturity. The only difference is that it has an equity option attached to it that has different impacts on the valuation. Different than straight debt, converts, if the equity option is out of the money, will eventually mature at par outside of any credit event within the company, right? There's no default, there's no credit event. In the years to maturity, that bond will mature at par. But unlike other straight debt, it doesn't have to mature at par, because the investor at that point, as you're approaching maturity, really has the choice to decide, what's worth more at this point? Is it the equity portion of the bond that I own, or is it the fixed income portion? Because ultimately, the fixed income portion will mature at 100 or 1,000, the face value. But if that stock is worth more at that point, the investor can make the decision to convert and that bond can be worth 160, 170, 200. So unlike traditional debt, the bond can have a lot more upside, which is obviously correlated to the underlying equity.
Right. So let's take it a mock example. So I'm just going to pick a company, IBM, and if you wanted me to pick a different company, let me know.
I had to convert in the past, so that's fine. Go ahead.
Okay, yeah. So they sell a bond at 1,000, and they issue it has an option attached to convert to 800 shares. So if the current price is 136, that's the spot price right now of the spot price of the stock, 136. Would the strike price of the option be out of the money? Would it be higher? Would it be like 150, 160? What sort of thing would it look like?
Well, so a company issues a bond. It has $1,000 face value. Underlying that bond is 800. I'm just going to forget about it. I'm just going to say $800 worth of stock. In the course of the life of that bond, right? The stock can move higher, can move lower, or do nothing, right? So 5 years to maturity, you have $1,000 bond with $800 of stock. Say the stock doubles in that period, right? You come to the maturity point. It's a bond. It's going to mature at par. Do I want to put this company back to the company and put this bond back to the company and take my $1,000? Or since it's doubled, I have $1,600 worth of stock, right? Do I convert that and take the $1,600? Of course I take the $1,600, right?
Yes.
Nothing happens to the stock in the period it's issued, right? Stock goes low, nothing happens, doesn't change. It opens at 100, closes at 100. You'll get your coupon, you'll get your par back at maturity. The stock drops by 40% in that period. Because it's straight debt, you will get your coupon and you got to get par back at maturity. The beautiful thing on this, and why if you look over history, converts have more equity-like returns versus fixed income, even though they're fixed income instruments, is the fact that you have that equity option that protects on the downside, where if the stock doesn't perform, but if the stock performs, you're going to participate in that growth over the course of that debt being outstanding, right? So you're getting an equity option on a piece of debt, and you have the ability to participate in the growth of the underlying issuer. Unlike straight debt, where you're just going to get the coupon and par at maturity.
Right. So when you said $800 worth of stock, was that assuming a sort of delta of 1, or was that based on the conversion price, right? Because and also is the conversion price when you buy from a primary issue, not secondary, right, from a primary issue, when you buy a convertible bond, is the strike price or the conversion price typically higher than the current price of the stock?
Correct. And that's exactly why it's interesting to companies to issue this kind of debt, right?
Yeah.
A tech company needs to raise capital. They go to bankers, and what do bankers say? Okay, maybe we can issue stock tomorrow. Let's issue $200 million worth of stock, or we can issue a convertible debt. So what's the positives, negatives of each? If you issue stock, you're going to have to issue it at a discount, maybe 10, 15% from where it's trading currently. I'm also selling into the same investors, the same investor group that currently are sponsoring my company. If you issue convertible debt, well, here's your ability to issue debt, spread it out your balance sheet, access different investors, and now you're selling that stock not at a discount to where it's currently selling, but a premium, right? Mm-hmm. So you'll sell that stock at 30, 40% above where it's currently trading. But what's the trade-off of that? For the investor, for me as an investor, I take a lower coupon, right? Because with that, I'm getting access now to 5 years of potential growth in this company. And for the issuer, right, it's a lower coupon, it's accessing different markets, and it's just diversity within their balance sheet.
Right. But so this is an advantage for investors like you, but a disadvantage for companies is that if they just issue the pure stock and IBM goes from 136 to 100, you participate in that loss. But you, as a convertible bondholder, you only get the optionality on the upside. So that makes it seem like, there are things of convertible bonds that can seem very attractive to investors. But I imagine there's no such thing as a free lunch in that you pay for it, right? You have to pay for that conversion, right?
You pay for it with a reduced coupon, right? So what we say is these bonds have what you call positive asymmetry. You have a defined downside outside, barring any type of bankruptcy or credit event. You have a defined downside of 100 cents on the dollar, right? your upside will be unlimited based on where it trades. So if you look at like discount convertible bonds and you're able to buy bonds at 85, 90 cents on the dollar, like your downside is basically the accretion to par and your positive return of the debt. Your upside is going to be that equity option kicking in and give you excessive value, over the time to maturity, which is 3 to 4 years out, right? So it becomes an interesting positive asymmetric investment proposition, and you're tending to access growthier companies that have those trajectories that potentially, are gonna put these options in the money in the future, right? So an issuing company, they trade off, when an issuing company will basically be selling volatility of the market, okay? Selling volatility of the market is something that they can't value on their balance sheet. It's something that they have based on the movement of their underlying equity price. And the higher volatility, the higher percentage that the company can sell that strike price or convertible debt above where the stock is.
Because it's an option and implied higher the implied vol.
Absolutely. So what you'll tend to see in our marketplace is you'll have younger, innovative type companies, growthier companies that are utilizing that kind of resource of volatility, which doesn't sit anywhere in a balance sheet, but it's something that's free to them. And they'll sell that to the market in return for a lower coupon, lower interest expense. So at that point of growth, that pivotal point where they need their capital, they're not sending out these big coupons to investors. They're able to hold on to it. Their trade-off is that, look, if the stock doubles or continues to go, it will basically be converted and it'll be dilutive at a higher level. But the other alternative was either selling that stock at a discount, which would have been dilutive anyway, or go into a straight market, which one may not lend to them because the companies tend to have, less big capital, like less big, materials and capital structures. They tend to have a lot of IP, tech-heavy type stuff, but they have a lot of growth in the prospects. So people are willing to lend to them based on their growth prospects, and just based on the current operating of the underlying companies.
Yeah. So Paul, there are qualities of convertible bonds that are attractive for investors, and as a result, they're somewhat unattractive for issuers. In other words, like why am I giving you this sort of optionality? So there's in the insurance, there's this, and I guess economics, there's this concept of adverse selection. So if you're selling car insurance, you're selling extreme crash insurance for sports cars. Like, I'm not going to buy that crash insurance unless I think, I'm going to crash my car, right? So the people who are going to be extremely good people to insure are not going to be banging down your doors. You're only going to get people like me. Likewise, if I'm, let's say, this super innovative company and everything's going well, and I'm making $1 billion a year, and Bill Gates' family office is trying to call me to invest, and I'm just not picking up the phone, like I'm likely not going to be doing a convertible bond, right? You framed it in a way that highlights the positive. You said growth companies companies that have a big potential for growth, and that's attractive to equity investors. But isn't it true that fixed income investors, they're interested in safety and they like to lend against collateral? So typically, a company that is speculative, and we can get into names later. A company that is losing hundreds of $millions a year, at least in net income terms, maybe if not adjusted EBITDA terms, and they don't have a ton of collateral that can be lent against. Those are the companies that would be selling convertible bond. Why are they selling convertible bond? Because they don't want to dilute their equity, and they can't really sell debt unless at a very, very high coupon, right? So, to what degree, push back on me, Paul, put me in my place and say, is what I said unfair? Is there a grain of truth to it?
There's this misnomer that, it's death financing. It's the last option for companies to come to the marketplace. But I think that's exactly, it's something of the past where that was, the last option a company had, bring to the convert market. I think now what you're seeing is because of the way the world is changing so rapidly, and things and technology are changing so rapidly, that the traditional company, a lot of the S&P companies are not these, plant and material heavy companies that access the high yield or straight debt markets. There's innovative technology. And when I'm saying that, we're not talking about these like pre-funded, early SPAC type situations. You're talking about companies that have, large revenue bases, investing in sales and investing in growth. And on the other side, you're talking about, established companies that are just expanding what type of capital they're raising, whether it's airlines or cruise lines or retails and consumer type companies, names that everyone knows. Just utilizing the product for those reasons, just to gain capital and expand their balance sheet and expand the markets that they're accessing. So I would push back at you and just saying that no, it's not these end of life companies that need financing at any cost. They're companies that tend to have really innovative, smart leaders, smart CFOs who understand that there are different ways to finance the business going forward, not just selling equity right here, right now. Right. So these options have been created over the years with, bankers structuring all different types of vehicles, and converts have been innovated over the years really to address that part of the marketplace, the part of the marketplace that would basically be raked over the coals to go to a straight debt market or not even considered. Right. And the market has really over the years funded some companies, like a lot of innovative companies, back from the early days to today.
Right. Yeah. So I didn't mean to suggest end of life companies, a company that's about to go bust, and they suggest. I meant companies that are. You said growth, but I guess the other way of putting that would be somewhat speculative, where they sort of need the money. They might be money losing. Like I don't know if I'm just picking a name out of a hat, but Uber is a giant successful company, but it's it doesn't make money. I think maybe adjusted EBITDA, maybe they made money one quarter or something. But those types of companies, right? Like Apple, Tim Cook, he's buying back stock. He's extremely defensive of his equity of the shares outstanding. He wants that number to go down. And if you buy or a convertible bond investor buys a convertible bond from Apple and Apple goes up because the price of Apple tends to go up, the stock, then Apple gets diluted, right? So there's something of tell us a little bit about the sorts of companies. Like there are those sorts of DraftKings like companies, right?
Sure. You have those type of companies that are like finding their way towards profitability, and then you have those type of companies like you've mentioned, Uber, Lyft. They're in our marketplace. The one thing that is interesting about a lot of these names is if you look at the market, 70% of the market has market caps above 5 billion, right? There's a perception that it's a small cap market. It's not like when you look at the broad base of it, it's not, it really runs the gamut of capitalization. So just as a disclosure, names I name, they're in the marketplace. We may not own them, but I'm not promoting them in any way. I'm just kind of giving you a taste of like what's in the market. You talk about the airlines, Spirit Air, JetBlue, Air Canada. They all accessed the market over the last several years. A Dick's Sporting Goods, a Cracker Barrel, a Cheesecake Factory, right? Yeah. Diversification. And then you go over to your Twitters and your Snapchats and your social media names that earlier on in life needed funding. When again, like market cap was there, growth was there, but profitability was maybe a year or so out. And really what the key is when you're investing in these securities as you approach it from a credit perspective, right? Because you've got to look at this as debt instruments which have equity kickers or equity options that are strapped onto them, right? Because ultimately, the protection in the security comes from the credit holded up over the course of that investment, right? The additional upside, the equity-like upside, comes from making that credit investment, and then the story or the growth of the company kicks in, the profitability kicks in, and then that equity increases and drives that greater return, that equity-like return over time. And as I mentioned earlier, you look at convertible returns, like Bank of America did a study back to 1973 forward, they look more in line with the S&P versus high yield and other fixed income indices, right? Has more of an equity-like return, even though you're investing in the security of straight debt, right? So it's an equity option that kicks in over time. So when it goes from, consumer names to technology names to transportation, Airbnb, Bookings Holdings, the travel names, there's a big diversity in market caps.
Paul, So earlier on, you said that there's a nature that once the option is not really in the money, it's not as correlated to the equity price, right? Because
Correct.
if something is extremely in the money, it essentially is the stock, and the stock is going to be correlated to the stock. But when the equity option is out of the money, it's going to trade more like a bond. Can you speak to that correlation? Because I imagine there are a lot of times, and I think we've seen this over the past 2 months, where as stock prices rise, interest rates fall and credit spreads narrow, right? So is it, to what degree is it sort of they're quite correlated to each other? Because like if you there is a company that issued a convertible bond and it goes bankrupt, that it's of course the stock's not going to go down and the bond went down too. So they're somewhat correlated, right?
Correct. So look, I mean, the market gets divided in two pieces. It becomes a fixed income portion, a fixed income market. Those bonds that are trading at a bigger premium out of the money option, that are trading at a big discount to the issue price of 100. So bonds trading in the 60s, 70s, 80s. Those are more of a fixed income like security. And we look at that as more as enhanced fixed income, right? It's a diversifying way of getting fixed income exposure, but very different than what you would allocate in a high yield bucket. You have technology, healthcare, consumer, which is very heavily represented in the convertible world relative to energy, industrial, media, telecom, which is in the high yield world. And then there's that other part of the market, which is more of like a low volatility equity, right? Because you have that delta, because you have that attachment, that option correlation as the stock moves up, it'll be more highly correlated as that option goes in the money, right? So on the lower end, it's more enhanced fixed income with a lower equity correlation. In the upper end, it's more of a low vol equity type strategy, and that's how you kind of divide the market to really, be attractive to different participants, different investors, right? Some can use it as a fixed income substitute. Others can use it as a low vol equity. So when you're thinking about how the market moves and how the securities work, when you have those big pullbacks in the market, you get more representation in that discount part of the market, more discount bonds, more bonds that are trading closer to their fixed income value, right? Strip out the convertibility. This bond is basically straight debt. What's the yield this should trade to, right? And that really attracts more of a fixed income crowd. Conversely, when you have equity markets moving higher, like you had in the back end or the early end of 2021, and like the market becomes more equity-like, and it takes on more of that equity-like profile as those options go in the money and the deltas of the market or the individual securities get higher. So depending on where that bond is in the curve, it will attract different types of investors who are just looking for different objectives, right? The key to converts, as I said, I mentioned this already, but it's equity-like returns over time, but with a much different risk profile, a lower risk profile than straight equities, than owning straight equities. Why? It's because when that equity loses value, right, you don't lose as much in the fact that you're basically stopped out at par, right? If you buy a bond at a premium, you're basically stopped out at par. If you buy a part of the discount, you're basically going to have that accretion to par for a positive yield to return. So I see you brought up the old traditional convert, which we call it graph here, and it really breaks the market down into the two parts, which are the valuation points, what values you convert, and how a convertible price acts over these periods. So that middle line where it says bond value, right, that represents the fixed income value of the security. No convertibility. It's straight debt. It's got to trade at a certain yield to maturity, right? Whatever this credit is, it's got to trade to this yield to maturity. That diagonal line coming across your screen, I think it's a green diagonal line, that represents the value of the stock underlying each bond, or the bond in this particular situation. And then the orange line that comes across, that's how a convertible bond acts at any 2 points. So if you start in the middle of this page, where it says, start where it says convertible price, and you start moving up to the right, the green dotted line, which represents what? The equity value, starts to converge with the value of the convertible. This is a bond with the options going way into the money, right? The stock is working, it's ripping, and now the bond is trading at a very low premium, no premium, and the option is going to trade almost 1-for-1 with the stock. Conversely, you come down to the left, and you see that orange line starts to kind of level off where you hit that bond value, but the stock is continuing to fall, right? So here, the bond valuation is breaking away from the equity because the equity is losing value, but your value in your security is being held up by the fact now that this is a fixed income instrument, that it's a fixed income value that's going to hold up. So it's going to dampen losses. It's going to protect your downside. Even if you got the stock wrong, even if you bought this and the stock goes down, you will have the bond will start losing value. You go over to the extreme left when you're talking about distressed. This is a whole different part of the market where now we have a credit event occurring and the bond floor starts to deteriorate because the credit of the underlying company starts deteriorating. So this on the far left where it says distressed, I think idiosyncratic credits, this is the point when you have that fall off in equity value along with credit value. So this is that plunging distress type security. But the sweet spot, the more asymmetric spot, becomes in this area between credit sensitive and balanced securities, where you have that positive asymmetry, where you invest in a security and it will outperform the stock on the way down by losing less, but eventually one for one move with the stock on the way up, right? So there's the upside capture and then there's a downside capture, which will be less. So over time, you make more on the way up, you lose more, you lose less on the way down. Over time, that string of returns is going to be much more advantageous than say just straight fixed debt, but much more advantageous than even equities over time, right? Because on these big pullbacks, there's a cushion to the pullback in your underlying security valuation. And again, as long as you're avoiding these things that are falling in this distressed level, the things that are falling off hard. But to mention that, if you look at defaults in general in our marketplace, historically, we went back to, I think, the early 90s, convert defaults around 1%. And that's relative to high yield and even leveraged loans, which is approximately 3%, right? So it's a much lower default rate within our marketplace. And there's a few interesting reasons why that is. Some like you hit on it earlier, that, companies that come to the convert market, they tend to have like light balance sheets, right? And convert can be the only issue that they only debt that they have on their balance sheet. So there's a large percentage, about 52% of convert issuers, where the convert's the only debt, right? The interest expense is much lower. If you think about a traditional default, like in a high yield name or heavy capital structure name, that default usually occurs with a missed coupon payment or something. Well, convert companies, again, lighter balance sheet, not a heavy interest expense. Well, they can tend to try to work this out prior to that point of you becoming current on that bond. When I say work this out, they can restructure a convert, they can issue stock. There's many things they can do that can solve the maturity coming up, opposed to what would happen in the traditional credit market. So converts tend to be the only debt on the balance sheet. It's low interest expense, and overall, that part of the market, that part of distressed market, is much lower representation.
Is that something that you typically try and avoid? Is a company that has a lot of debt on its balance sheet already? And then also just looking at this chart between distressed, credit sensitive, balance, and equity sensitive, in those four zones, which do you specialize in and why, and to what degree, if you're in the credit sensitive spectrum, how is that different than the folks who are maybe, down the hall from you who are trading the equity sensitive stuff?
Yeah. So look, so in my firm, we do focus on both the credit sensitive and the balance portion of the marketplace. And they're two distinct products that we have out there. And what we're trying to do really is appeal to different investor sets. So if you're looking at the credit sensitive portion of the marketplace, you really are creating a portfolio of fixed income instruments with 3 and 4 year options attached onto them, which can give you, a different type of return profile than, say, just owning a portfolio of straight debt, right? One of the things I haven't mentioned yet is, a big thing in fixed income, obviously, is duration. What's your duration exposure? And how does your portfolio going to react when rates are rising? A typical convertible portfolio has a 2.2 year duration. So you own a portfolio of fixed income instruments, but a short duration, right? If you look at like the ag, it's a 6 year duration. Obviously government bonds even longer out, high yields around 4 or 5 years. So it has different drivers of that return. So within this credit sensitive part of the market, this is where I invest for my client base. And it's really attractive to two groups, right? It's the institutional account that's looking for diversity or enhanced fixed income type solution, right? Some way to adjust their or some way to enhance their fixed income returns utilizing fixed income instruments, low volatility instruments, low standard deviation, but gives them excess returns over the cycle. Additionally, another part of the market that's very that's attractive to this part of the market is typically the wealthier individuals, private wealth groups.
Yeah.
Right? Because it's a strategy that's investing on a credit basis with the idea of preserving capital with a very defined downside utilizing this convertible instrument. And the defined downside is the credit floor. But the outsized upside comes from your sourcing 3 and 4 year options that are strapped onto these bonds that at this point in their life, they're less valued by the market because they're out of the money, right? The traditional convertible investor really looks for that higher correlation to equity. This credit sensitive part of the market is just less, it's just less trafficked in. So the profile is really just, investing in securities that have limited downside in the shorter term, but have a large potential upside because these stocks tend to be out of favor. The bonds are trading at discounts. And again, the worst you're going to do is bond accretes to par and you collect your coupon and the bond accretes to par from the point of purchase. And the best, and what we often see, it's this equity where the option has fell out of the money, the stock is depreciated precipitously, whether it's earnings call or whether this recent macro sell-off. These equity options have fallen out of the money, but look forward 2-3 years from now. I mean, are these stocks going to be trading at the same spot? There's a good chance that's not going to be, right? There's a good chance there's some value in these options that can be unlocked over the 3 to 4 year period to these bonds maturities. So it's an interesting way to source fixed income securities and long dated options attached to them, not trying to be complicated because those options just sit within the structure, right? So it's not, and to try to go replicate that, very difficult. I mean, one, you can't really find 3 and 4 year options out in the marketplace, and the volatility you're going to pay for that, it's off the charts, right? You can't source that. So here you're buying very cheap volatility, a fixed income instrument with the potential for outsized returns, but with the protection of you'll have a slight positive return to par, right? Some positive return to par. And that part of the market now has become extremely interesting as obviously with all, credit instruments, all credit markets, the yields have expanded somewhat, right? And so a portfolio of these credit instruments could yield, 5, 6, 7%, and you have options on equities that, have dropped precipitously in the marketplace. So this is is a part of the marketplace that, again, less trafficked, but has become more and more attractive to certain groups of investors.
Paul, the last time we spoke, it was during the heat of battle. It was all risk assets had plummeted. It was pretty close to mid-June, the absolute bottom for the S&P 500. Since then, the S&P 500 has rallied something like 17%. We're now recording on August 16th. And at that meeting in June, when I first met you, you said, Jack, you said, Jack, 65% of the convertible space now trades at below par. It's the biggest I've seen in my 25-year career. And you were extremely bullish at that time.
Correct.
And over the past 2 months, risk assets have rallied and, equities have gone up, credit spreads have narrowed. So I bet convertible bonds have done well as well. Tell us, why do you think equity prices or convertible prices were so dislocated at the time? To what degree were they representative of the fundamentals with credit spreads and equity prices? And then, what's the past 2 months been like?
Yeah. So look, I mean, interesting anomaly in the marketplace, and it really has to do with kind of the whole impact COVID had on our market, and the point leading to where we are today. So COVID hits March of 2020, everything shuts down, and basically the world comes to a stop, right? A lot of companies are not really built to work with no revenue and in a shutdown mode. So quickly after you had kind of that liquidity insertion from the Fed, you had a lot of companies looking to access the marketplaces. So they issued debt, they issued converts, and the converts came in size. So over the course of the last 2 years, the market expanded considerably, with over 2 years of 160 billion plus of new issuance coming to our market. Initially, starting out with the retailers and the transportation type companies like the Dick's Sporting Goods and the Blooming Brands and the Burlington stores, who needed capital just to run the business at that point, right? Market shut down, revenues go to zero. And then that was followed by technology companies and additional type consumer companies, or as the process went on, that hey, look, there's this big shift of, we were in an office environment, now we're home. Software companies are expanding, pretty strongly. The technology is being adapted. We need money to continue to improve what we're doing. And that was a big move on the back end of that. So the market diversified, the market grew, right? And then from there, you just had this just expansion of players within our marketplace, because now you had this larger opportunity set. Market grew over 600 billion in size, which is very large historically. The last time we hit that point was probably back in the early parts of 2007. And it just attracted different types of investors. You had a question? Okay.
Yeah. So the last time you said it was 2007?
Yeah. 2007 was the point we got to that size in the marketplace. Correct. Over time, converts have always been used as kind of like this mechanism for companies who are kind of newer to the world and to fund their growth, fund their expansion. And like we've internally we have we call him the professor, someone who used to work with us now retired from the firm, who they look back historically, and going back to the 1800s, converts were used in the railroads, right? You had these innovative transportation companies looking to expand out west, and they needed money. They used convertible bonds, right? You go forward into the early 1900s, it was American Telegraph and Telephone, AT&T as we know it, General Electric, Westinghouse, names like that, technology names like that. But now you come forward over the years, the convert market's always kind of been this retail-y, 50 billion or so size market, until a real change occurred in the 1980s, where basically bankers just were looking at the product, and they started to get more innovative. And really innovation came where, in general, bond markets were becoming more tradable. They were becoming more open to more daily trading and volumes, where historically you'd buy a bond and hold it to maturity, right? That's how the bond market worked. Now they become trading instruments where people were moving out of them a bigger size. And then, one of the houses, Merrill Lynch, saw this opportunity to create a product that would be more institutionally friendly, right? And that was, it was called the Lions product, which is an acronym for the liquid yield option notes, right? And what this did was it created this whole marketplace where companies can come to the market. They would issue original issue discount convertible bonds. Traditionally, these bonds would have 20, 30-year maturities, right? But what they did differently here is they put puts in along the way, right? They restructured this product. They put puts in along the way. So me buying a 20-year credit, that's really difficult. That bond's going to be very volatile. But now that you have a 3-year put, well, that's interesting, right? Because you have an accretion to the bond of the original issue discount. It's going to accrete to a certain put price, which was higher than the offering price. But you also have that equity optionality, which created that floor to the bottom side.
And how common is that for, instead of getting a call options in the convertible, you get a put? How common is that?
Some securities are still built this way, where you have puts as well as calls. Okay, but no, so that product itself started a larger institutional following, right? And then the market exploded to the upside and became more of an institutional investing type scenario. So now fast forward to where I got involved in the marketplace 25 years ago. A gentleman in that group at Merrill spun out of Merrill Lynch after about 12, 13 years of running that desk and being one of the top sales producers. His name is Tracy Maitland. He jumped out and he started Advent Capital, where he saw this institutional demand for the product, but no one really servicing the product, no one really selling the product in a management way, right? Asset managers out there selling the product as a standalone product. So initially, the market was I joined in, what was it, 1997, right prior to, that whole run in technology and dot-com bubble, dot-com burst area. And, people be surprised. I mean, Apple had a convertible back in the day. Amazon, right, when they were a book company, they issued 3 convertibles over the lifetime. And there was one point people were afraid that we weren't going to get paid back, right? Amazon, how can you even believe that? But those were the type of companies that were moving into the market. So as the product got more institutionalized, more players got involved, mutual funds got involved, ourselves, outright managers got involved, and larger asset managers got involved. And we're really selling this into, like, the traditional circuits, the traditional pension allocators, endowment allocators, and different retail platforms. And the market itself began to grow on itself, hitting a height in about 2007, prior to the great financial crisis, which pulled back. In that period, converts pull back pretty hard, right, with the rest of the market, but managed strategies tend to hold up much better than the broader marketplace, especially if you looked at it through the eye of a credit perspective, right, the credit perspective of the names that held up in that period. On the back end recovery through that financial crisis, on the back end of the financial crisis, the convertible market, given the fact that you had both credit and equity, driving valuations through the back end on the upside, gained back all of its losses towards the back end of 2009, where it took the S&P, I think, 2012, 2013, just to break even. So the convertible market came out of that in a pretty strong manner. Since then, there was ebbs and flows with different types of things going in the market, where it came to, issuance and companies coming to the market. There was a point where a lot of REITs used the product, different types of technology companies, consumer companies. And it really wasn't until this recent pullback in 2020 where I had this another mass explosion in issuance and in issuers in the product. And with that, really, it just expanded the opportunity set. It got other participants in the market more interested in the product. The one thing I haven't mentioned with converts, which is very different than, say, like loans and different types of securities that require different types of trading and different types of settlement. Converts are CUSIP traded bonds. And because their characteristics are so different, you do have transient investors. When we looked back at that curve that you showed, you have transient investors in this marketplace that, based on those metrics, will get involved. So as you get into that fixed income part of the curve, like, you will have fixed income investors or fixed income mutual fund managers buy convertible bonds because it fits within their mandates, right? As you move up the curve and the bonds become more equity-like, you'll have equity income funds buy into convertibles. So along the curve, there are different pockets of liquidity, not just traditional convertible investor. And obviously, as you go down to that left, you get into that distress part, you got that crossover credit and distress investor that comes through.
And that's just a team of lawyers.
Yeah. They're the smart money with a team of lawyers behind them, right? When we talked last, the market was kind of the broader market, not just about converts now. We're talking about the broader market, right? We were talking at the height of the sell-off of equities and credit, right? And I was telling you, like, look, I saw this before. I saw this before in 2000. And I don't think this is over right now. I don't think we're through this. We're in this lull in the middle of August that you could potentially have a revisiting. But the opportunity in converts expanded so drastically, where not only the opportunity set, the names, the amount of names you could look at, but slight little dislocation occurred in one part of the market of a lot of these high valued equities that were higher valued last year, where the stocks have now come down 60, 70, 80% from their highs, right? Huge reductions in equity prices. But you still had like a $10 billion market cap. Converts the only debt on the balance sheet. They still had most of the cash that they raised. And if you look at kind of the burn down of it, like how they get to the end, they still have the ability to pay that off, even with the current metrics on the company, right? So there was a lot of interest, and they're still out there. There are a lot of these interesting opportunities to buy these credits where you can't access another market, so you just don't have debt in those markets. You access these credits of equities that have been just pushed down to such a low level. And I say I feel it's very similar to what I saw back then. The only difference is that we weren't in that same like financial crisis, right?
Mhm.
This is more of a kind of like the economy has to kind of correct from all of these things that occurred over the last 2 years. This environment that we were like unexpectedly were put in through COVID, and on the back end of it, adjusting to the liquidity that was put into the market, the moves that the Fed has had to make, and it just created this opportunity where these bonds there's such I guess a larger amount of bonds represented in this fixed income area where they're naturally are being sold by the more equity like guys who like the equity sensitivity, not quite yet in the distressed area, that it becomes a lot of value, good value. You're buying really cheap credit, and they're basically valuing the options for nothing. So if you're an options guy, right, and you're looking at a 90-day option or of Snapchat or Datadog, right, stuff like that. You look at these 90-day options, like they're implying 16, 70%, right? But sometimes, and I'm saying these particular things, but sometimes you can access this option within the convertible structure at a 30 vol rate or a 40 vol rate. And now you're talking about 3 and 4 years out. Like, where are you going to find a 3 and 4 year option? You're not, unless you have some banker write it for you, which is going to obviously not be priced properly, right? So it's really become an incredible opportunity in the market, and it's still there, right? Yes, we've had a rally from those bottoms, but there's kind of that sense in the marketplace that, people may be away. September may bring different things. And you need to really look forward that, we're still at these high inflation rates, even though the trajectory is going in the right way. We're starting to see some corporate layoffs at the higher level, right? Not more broadly in the economy yet. And that's kind of the opposing type factors we're seeing is, a combination of where rates are, what inflation is doing, and where employment is. But there are a lot of mixed signals coming on, right? And I would just say that looking where to invest a dollar today, it's very difficult, right? How do I buy an equity right here, right now, after this run we've seen in the shorter term, where we don't know what the longer term or even several quarters out looks like? A lot of high yield debt is tightened to a point where I speak to some of the high yield managers, and they're like, well, it's gone a lot, very quick, very far.
Yeah.
Right? But now you have this other product, which kind of has this hybrid of both. You have that credit tilt to it with an equity option, where even if you do push back, you may do have another, say a 10% drawdown in the equity markets from here. You're going to be very cushioned through the product, right? Mm-hmm. But you're kind of poising yourself to be participatory or participate in the longer term, in the longer term move in the marketplace, where it eventually gets back on track, or there's eventually a point where equities can move the trajectory higher.
So, Paul, if the sell-off from the beginning of this year, let's say January to June, had 3 characteristics across all asset classes, which is rising risk-free interest rates due to the Fed and other central banks, and then widening credit spreads, and then widening equity risk premium, basically lower equity valuations, which of those 3 was your greatest enemy going into, or the greatest enemy of the convertible bond community, let's put it that way, going into June? And then which of those factors has been the greatest ballast higher over the past 2 months?
Yeah. So it's interesting enough that because of the types of companies that came to the marketplace over the last 2 years, they tended to trade at a higher PE level, right? Or just a higher valuation or multiple of revenue or
price to sales.
Yeah. So I would say the greatest enemy to the broader market was the devaluation in these type of companies, basically the lack of interest in non-cash producing companies. That was kind of the overall theme in the equity markets, right? Because that's the part of the market that most got hit, and that was largely represented in our marketplace. So the underlying equities of converts did underperform, say, the S&P and the NASDAQ in this period, right? What helped us were the credits and balance sheets, right? Because eventually when that stock went down enough, those credits start to hold up because you start looking at these market caps, you start looking at the balance sheet. I mean, a lot of these companies issue with zero interest, zero coupon bonds at a premium. So even though if the bond is trading 80 cents on the dollar, there's zero interest expense for them over the next 4 years. And so they have great technology, they have great companies, they have great growth prospects, and even if you brought those down and you hammer them in the current market condition, you cut them, you see your way through to a back end where okay, the company will exist, and it's really up to the market. One, it's up to them to grow into some of their valuation, but the market has discounted this valuation so much that as you start seeing green shoots to the back end, as you see the Fed kind of start to back off, what are the first things that are going to move? Like you tell me, what equities are going to move first? It's not, it's going to be those type of equities that people go back to. They go back to growth. They go back to innovation. So that really sets the product up for the next 2-3 years out to really, outperform, broader credit markets, say, because I'm looking at this as a credit instrument, to really outperform broader credit markets. So what initially was the hit to the market or the downfall of the market is now becoming a really big opportunity set, right?
Right. And what point, so you manage a fund that invests in these convertible securities. How do you view your role as I'm going to make sure that I have the best baskets of securities on a quantitative basis, whereas, Joe Schmo or Jack Farley or whoever who's buying convertible bonds, like they're not going to be looking and paying attention to these things with as much rigor and attention as me? Or do you view it as you're sort of picking styles, as you're less so a convertible bond investor and you're more of a sort of growth equity investor? Because it sounds like based on the composition of the companies, that is a lot of the sectors that the companies are involved in.
See, I love the instrument for what it is, and that's what I'm investing in. I'm investing in the securities and the credits, right? And the securities are the most brilliant thing, and that's what people like. It's hard to get that out there. That putting $1 in a convertible bond at a discount, you're going to make money. We don't know how much, but you're going to make money, barring the default. You're going to make money, right? Whether it's it's going to be a positive yield, and you have that potential for an outsized, upsize return, right? And the key to investing over time, right, is losing less in the downturns, losing less on any one investment, but participating in the upside in growth over time. So what I'm looking for is a structure, right? The structure where I can put $1 into the marketplace may have 2 to 3 points of downside in the shorter term, but then my upside is 7 to 8 points, right? So the asymmetry, there's a positive asymmetry in that investment. And then 2 is that credit perspective, right? Because that makes you avoid that really big drawdown, right? That really big drawdown. So if I buy something and something drastically changes within the credit, I'm not afraid to sell that. If the market changed, something changed, I'm not afraid to move that out of the portfolio, really, because that sweet spot is kind of finding those securities with that best, say, positive asymmetry. So you're basically sourcing out of the money stocks and out of the money options through that fixed income instrument. And it's so powerful in a recovery to have that combination of both credit and equity pushing together, right? And that's what that creates that really interesting portfolio for my investors, right? So the other key to it really is like, when do you leave an investment? And part of, because converts can morph into an equity product, like that risk of that security no longer has the traits that your investor wants. So as it migrates up the curve and you have those bonds that trade with a higher equity value, a fixed income convert guy will move out of that security because the asymmetry is no longer there. Right now, you're solely dependent on that stock to work to go higher, right? So again, the type of investors, the wealthy individual who wants market exposure, right, but doesn't want to buy straight equities and may not find the credit opportunities they want, you can utilize like that discount convertible product to get exposure to the markets, protecting your principal, but setting yourself up for outsized returns in the future. So it starts with the structure. We look at the credit very deeply. Credit team here, and most people investing this part of the line really have to, part of the curve, really have to have the lens on credit investing. And then the third is that equity option. Like, can there be a recovery in this equity to give me that more outsized return? It's not just that fixed yield to maturity, right? Because that's the kicker there. It's getting that growth piece to kick in over the life of the bond, right? So if it's a shorter dated option, 1 year, 1.5 years out, maybe that doesn't have the interest that you wanted. Maybe I'm not going to be able to get to that point where that equity option kicks in. But when you're looking at 3 and 4 years out, Well, look, that's pretty short for the company, meaning that that bond floor is going to hold 3-year paper of a company that you can analyze the credit. That floor will hold, so your downside will hold. But now you have 3 years post this current market environment to participate in the equity. And again, a lot of them have come down pretty hard, just in the broader market as well as in our market. So it's a great opportunity in this part of the curve, and just currently what the market is giving us, it's giving us excess opportunity to not only invest in like discounted credits, but also discounted volatility.
Mm. Yes. The last time we spoke in June, I would say you were somewhere on the spectrum from bearish to bullish. I would say you were pretty bullish. What is your outlook right now?
Yeah. So look, we've came a long way in a short period of time in a pretty low volume marketplace where a lot of people are waiting for the next signal. I would say now I was very bullish then for the simple fact that the opportunity set was just screaming at me, right? It was like, okay, there's so many things that we can buy right here that make a lot of sense over the course of time. I would say now I'm just a little more cautious on the potential of what's going to go on in the next couple of months as we get more data coming out. The markets move at a very rapid pace. Whether it's because of how it's made up these days through algorithmic trading and passive investment styles. But I would say I'm just a little bit cautious right now on what the broader market's going to do. But when I still look at my portfolio, the nice part about active management within this type of structure is that you can naturally reduce your risk and really focus back on the part of the curve, based on movements in the bonds, right? Because if you don't actively manage it, you buy a bond at 80. I mean, that could be at 140 in a couple of months, and trading 1-for-1 with the stock, and therefore your volatility is going to pick up, and a pullback comes in the market, and you're going to draw down just as much as the broader market did, right? So actively managing the part of the curve you're in is very critical to keeping that lower delta profile, lower vol profile within a portfolio. But in saying that, it's the opportunity still, it ebbs and flows, right? Even through this earnings season, several names have just drawn right back down into that sweet spot, and other names have moved up and out. So the opportunity set is continually refreshing itself, but it's still, over 55% of this market is on that discount level, right?
Right.
And I think something you asked me at the other point too is, hey, what about the busted part of the market? People like to talk about busted convertibles, right?
Yeah.
And the thing I came back to is, like, I know people love to use that name, but like in that part of the market, I would say like busted implies the option has no value. I just think now, because of the extreme moves in these equities, that option does have a lot of value, that the volatility in these underlyings were so high that even though people are not really valuing that, it's the hidden part. It's that hidden gem within these discount securities is to get access to that option. So yes, people will continue to call it busted converts when the bonds are trading with a high premium or out of the money option. But I think that's part of the attractiveness of that part of the market is the fact that people may not be valuing that option too much, right? Mm-hmm. But historically, there's always been, those parts of the market, the busted part, the balanced part, and the equity parts.
I mean, there's a lot of busted equities, just IPOs. And
Exactly it. There's busted equities too, just that are in different forms, right?
Yeah.
Different forms.
Right? Yeah. Paul, so single stock volatility, let's say on, DraftKings has been very high. Carvana, these sorts of names, even though the VIX and the broader index has not seen as high levels of volatility. But the MOVE index, the volatility in bonds, treasury bonds, notes, bills, very, very high.
Correct.
And you said the duration of the average convertible bond is 2.2 years. And I'm thinking the 2-year treasury note is bouncing around 25 basis points day after day. Are you seeing a lot of volatility just in the fixed income space, not leaving aside the equity vol?
Yeah. I mean, look, as the market is trying to find its floor and it's trying to find how to price assets in general, there is volatility within the fixed income space, and there's volatility in our space too. It's a natural market where there's buyers and sellers at every point, and really, the desks that we transact with, right? It's an over-the-counter market. Didn't mention that it's very over-the-counter market. Most of the large banks do transact in it, but those desks have to find the next interested buyer, which could cause volatility pockets. But as you're saying, like as the 2-year Treasury is moving, equities are moving, and conversely to that, right? And that's creating like just different pricing valuations for converts, right? Because as the equities are rallying, credits have kind of stabilized, and at the same point the reverse occurs. I'm just thinking going forward, maybe you don't hit that depth that we were at in June, right? At least in the near term, where floors were put in and a lot of interested buyers step into the marketplace. In any of these, historically, in any of these type of, volatility or drawbacks in the broader market, you have that move lower. And once you get one of those rallies, right, you almost get that FOMO that goes on, that when you get that pullback again, you'll get investors to get interested. You'll get investors to jump in and make allocations or pick up paper at lower levels than where they're currently traded today. But yeah, so let's say like the average duration is 2.2 years. Obviously, some of the more fixed income securities maybe have a 3.2, 3.3 year type duration profile. But net, it's pretty darn short, right?
Yeah.
It's going to move around with broader markets. I mean, the pricing's going to move around with broader markets. That's it.
Paul, in June, you said that 65% of the bond market convertible bond was trading below par. Now that we've had this pretty significant rally over the past 2 months, what is that now?
Yeah, I think it's around 55% now. Like 10% of it moved up, and like below par is 99, 98 or so. But I think everything kind of moved up a level, right? The yields have tightened just a level. When you're talking like 4 to 5 points, bonds have moved up off the floor. And you saw it in the high yield markets as well, right across credit markets. So there's still a large opportunity set. It's still large, relative to historics. And it's just like a very advantageous part of the curve.
And Paul, what's something that, when you look at a convertible bond, something you see that you say, no, we're not going to do this deal. I'm not going to buy it. What are red flags you look for?
Yeah, look, most convertible bonds have all kind of the indenture protections you need. It's not like some of these markets where you get covenant light and the sorts. You have all types of protections written within. What I don't like in some of the issuers, or those are like, we have some pre-revenue issuers. I won't touch that kind of stuff. You have issuers that are too young to have an operating history, or there's an issue in management. So there's a lot of that where you have to look through these securities, and because the proposition of asymmetry is held up through credit, if you can't define the credit, and if you're just basically purely investing on a story, right, a market cap with a story, that can really end badly for you. Now, I'm not saying that they haven't been successful over the years, right? And I'll pull out a name for you, which was one of the bigger issuers in converts at a time where the company almost folded, and it's Tesla. Everyone loves Tesla. Tesla survived based on issuing convertible debt. And there was that point where, Elon was going a little sideways, and they were starting to build a tent to produce cars in Fremont, California. And they came to the convertible market, and they raised the capital they needed to get through the short term. Tesla, I think, had about 5 different convertibles in the point of their life, and really with that bridged them to profitability. Now, it's a different entity in the fact that this company had a whole different following behind it, but at that point, it was a story. And initially, I kind of passed on it until there was more viability within it. So they had bonds that were trading right where we have bonds trading today, in the 80s and the 70s, right? And then once the equity story started to play out and they started producing cars and they hit profitability several quarters into that, the stock started to move. And these bonds that were trading in the 80s, 110, 120, I mean, their bonds trading at $1,200. The last Tesla bond out there, it's very, very small amount, but there was such a massive return in those securities by funding Elon Musk in that period, right? So he was a big user of the product, and you can say that at that period, it was the lifeline Tesla needed to grow. No straight debt market was was lending to Elon Musk and Tesla at that point. But the convert market, given the fact they saw that 4 to 5 year option I could buy right here, right now, right, on a company that's pretty darn innovative with a great product and a strong leader, that worked for them, right? That worked for a class of investors, right? But I tend to like to see, profitability. I tend to like to see balance sheets that I can see through to the endpoint, and see them being able to pay back, or companies being able to pay back this debt. Because again, like the typical investor in this part of the curve doesn't want to lose money. They want to just kind of be in the marketplace, with that set return, but the potential for that outsized return.
Paul, what do you think is the greatest risk for your side of the market going forward? Is it widening credit spreads? Is it defaults? Or is it falling equity values? Or something else?
Yeah. So look, I mean, it's a combination. That's a perfect storm. Falling equity values and defaults increasing, right? That's a perfect storm for any market, right? All markets. That would be, I would say, like, would overall, credit markets in general are fearful of continued widening spreads and equities selling off to a point where it just puts additional pressure on capital structures, right? So that would be the same for the convertible market. But as I said, there's a heck of an opportunity, and I think what we're seeing is just more interest, say, from investors, allocators at the product, given kind of the benefits it can provide in a current uncertain, volatile market, right? Again, you're getting equity exposure through a fixed income instrument, so at least there's a floor to the loss, but you have this really strong potential or ability to participate in the upside when and if the stock moves higher, right?
Yeah, Paul, talk to me about the floors, because if you hold all convertible bonds to maturity, the floor is 100 unless it defaults or there's some sort of
Correct.
restructuring.
Correct.
If you are trading things mark to market and the company does something you don't like, you can sell it. Perhaps you would sell it, at a lower level. You mentioned to me before that you've never had a default, and you said on this call that the defaults historically were at like 1% for convertible bonds. Why? How did you avoid defaults? Were there times when you had your fund held a security and then you sold it, perhaps at a loss, but then it later defaulted and you just got out at the right time? And how sensitive? You based on this call, you sort of view it as, you said a floor is something that it can't go below, but it can go below if there is a default, right?
Correct. And that's why it's, again, investing in the credit and continually monitoring that credit is very important. So having a disciplined approach where you learn where to sell, whether it's working, whether it's not, has really allowed us to avoid those really deep drawdowns on individual securities. And I would say a great example was 2015, right? When you had really high volatile energy prices, where the price of oil went from $100 a barrel to $20 a barrel. And you had a lot of names like Weatherford and Chesapeake with convertible debt. That was good balance sheet, company, producing a lot of oil, revenues coming in, cash coming in, and they're continually growing. But then when you started looking at the cost of production relative to the price, the dropping trajectory of underlying price of oil, a barrel of oil, numbers didn't start to work anymore. And as you started going deeper, $30, $20, like there's no sign, to the back end of this. So when those type of events occur and you're staying on top of what's happening, you're gonna, that's when you reevaluate and say, you know what, this floor won't hold. And you're right, the floor does move down, but it takes time for it to kind of really develop to a distressed situation. It's not overnight, right? There's a negative headline. That's where it comes, it takes the kind of professional look at the credit and just determine that this is really not worthy for investment anymore. And you move out of those type of situations. And we very successfully moved out of a lot of those oil names in that period. Unfortunately, in this latest, move higher in the energy space, there's very little representation in our market there at this point. So it wasn't something that, convertible investors had access to, but I'm assuming most debt investors had access to that through high yield or other types of credits.
So, Paul, how much attention do you pay to the Federal Reserve? Now the Fed funds rate is 225 basis points, projected based on the interest rate futures market to be somewhere around 350 basis points by the end of the year. On the face of it, if you buy a convertible bond of a company that's growing, it's profitable, on the face of it, interest rates at 225 versus 250, it shouldn't really make a difference, but we see that it does. And, days where the 2-year yield spikes higher are days when growth companies typically have sold off, at least this year. So how are you thinking about that as a risk? How much attention are you paying to the Federal Reserve? Is it sort of like a professional hobby of yours, or do you think it actually, really is driving a significant part of the price action of your book that you're managing for investors?
Yeah. So look, historically, if you look back in periods where interest rates have risen, convertibles have outperformed other fixed income asset classes.
Because of low duration?
Sorry?
Because of low duration?
Well, not only because of low duration, because in those periods, equities tend to be doing better, right? Because that's a point where they're trying to slow down the economy. Equities tend to start moving higher. So initially in this front end of this rate move, there's more of a shock and equities are repricing themselves. But I think as we see through the back end of, as we start seeing to the back end, to the end of this rate cycle, you're going to have a revaluation on equities that would probably drive convertible valuations to a higher level, but the fixed income market is still held back from the pure spread situation, right?
Yeah.
So that, stable into improving environment in the market, or the rise of rates within the marketplace will tend to be accompanied by that rise in equities. Now, again, right now we're not seeing that, but I think as the full cycle goes through, we're going to have that back end benefit in our product.
Great. Well, Paul, it's been a total pleasure having you on Forward Guidance. Thank you so much for sharing your insights.
Yeah, well, thanks, Jack. And I hope people can understand a little better what the convertible product's about. It's a unique asset class, but it's one that, even though it is overlooked, it should be given more consideration by not only institutions, but also the retail side of things. And there's great ways to access it out there. But overall, it's a developed market and one that's very advantageous for investors all around.
Yeah. Well, Paul, but let me ask you a question about that, just because we've been talking about it for over an hour. So I get it how a highly intelligent, disciplined, experienced investor such as yourself and as your team can select specific securities that have low default risk as you perceive it, and maybe they can do well in the equity, and the call option attached is going to be cheap. But that is, you have to be. You said it's really not that complicated. It's not that complicated, but you have to understand, an intermediate level of finance, and you have to be actively managing and going through QSIPs, as you say. So, the average retail investor, maybe an investor watching this program right now, if let's say they maybe buy Microsoft instead of buying Apple, like Warren Buffett, Warren Buffett doesn't really have a huge edge over them, purely in terms of understanding the security. Now, over a long term, obviously that compounds. But I'd like to think that you have a pretty massive edge, and you have a bigger edge over the retail investor buying convertible bonds than like Warren Buffett does buying stocks, right? Because stocks are kind of easy.
So let me put it this way: Snapchat. Let me just throw a name out there, right? You can buy the stock today. It's going to be moving up and down all over the place. You can buy a convertible bond with a 6.5% yield for 4 years. Okay. People know Snapchat. They know what they do. Retail investors are buying that day and night. Now, in the next 4 years, Snapchat's right where it is today. You'll make 6.5%. Right. If that stock moves higher in these next 4 years, right, that bond could be trading right now at 75. It could be trading at 125, 130. You can technically outperform the stock over time with the convertible bond. So simplistically, getting away from all the credit and deep whatever, simplistically, if you look at certain names that you like to own, or you want to own as a retail investor, there are a bundle of them, or a good amount of them, that do have convertible debt that if you were to purchase, the asymmetry of the return is so much more beneficial. No, everyone loves the big score. You buy a stock at 12, it goes to 24, you sell it, you tell everybody about that. But nobody talks about the stock they bought at 12 and goes to 2 or 12 and goes to 5, right? A portfolio of these type of names, like the Snapchats, the Ubers, the Lyfts, the Airbnbs, a portfolio of these type of names, and like names that people invest in equities. Retailers invest in equities. You don't, if you believe that company is going to be around in 4 years, right? You can buy that piece of debt, have a guaranteed return, and the potential for a massive upside return, right? And it may not be as sexy as buying the stock, but it's a way to like preserve capital and have outsized returns over a period of time, or over say the 4 years right now. And mind you, just go to Snapchat. It was $70 12 months ago. Where's the stock? 14.
Right.
We can argue with we can argue about the valuation of it at any point, right? Anyone can do an equity valuation. But as they work through their certain situations, maybe that stock can go to 24 as the Fed starts. Maybe that stock can go to 30. Maybe the stock can go to 5. If the stock's at 5, you're still going to get your 7.5%.
Paul, yeah, you're arguing on the beta, and I think you've done a really good job of arguing that. I'm arguing sort of on the alpha, that I think there is more, for investment managers, perhaps you can take this as a compliment, like earn the fee. Like if you're paying someone, 2 and 20% to buy Apple, there's not that much edge there. But there's tons of things that can happen, idiosyncratic things with the Snap convert, where a call option attached could be extremely undervalued, and you and your team, someone on your team would flag that to you, and you would buy it because you're doing this all day. Unlike retail investors who, their job is not investing. And likewise, something really weird happened and there's a credit thing and you sold it and you got out of it, that maybe the retail investor wouldn't. So would you agree or disagree that there is more alpha than in the equity market for sort of institutional investors?
There's absolutely more alpha to be had, right? There's more alpha to be had in the product, just given the nuances of how it works, right? In the fact that, again, it's a credit instrument with the equity option, and the payoffs are different at any point of where the equity is trading and where the credit is trading. And to access that alpha, it's just, you're right. It's not just a pure beta play going long something. It's finding those nuanced securities where it's mispriced on the credit side, it's mispriced on the volatility side, and that purchasing that on behalf of a client or just in general gives you an edge up on the broader market, because you're getting exposure through a security that's not only just a discount in price, but a discount in valuation. Right. And that's identifying, that's what we're doing here, is we're identifying those valuation discounts that are more advantageous for the client base.
Wonderful. Paul, my final question for you, I promise, is what is the most frequent mistake you think investors make when investing in convertible bonds?
The most frequent mistake, that's interesting.
Or the most costly mistake, you pick.
Well, look, it tends to be getting out too early is the most frequent mistake on the upside, where, strategically, if you think you hit it, like strategically, if the bond gets to a certain level, 120, 130, you move out of that security, and then you have a Tesla-like scenario where it just keeps going, right? And strategically, and on the downside, the biggest mistake is holding on to that loser too long, looking for that turnaround, right? Because you can hit points where there's no natural investors anymore, and the bond can just drop down till you find that credit crossover investor. So really protecting your capital on the downside, and not falling in love with the fact that, okay, you made an investment, you may have made, it looked like the right decision at that point of investment, but as things change, not reevaluating that and not taking action because the bond is lower. It's not the case. This is a portfolio of securities, right? It's a portfolio of securities that you're looking to make an ultimate return on, and you're not going to get everyone right all the time. As a professional money manager, knowing when to cut that loss and just moving on to something else makes a lot more sense on the downside. So those are kind of the two mistakes that occur in our marketplace. But yeah, I think that could happen in any market, truthfully, right?
Yeah, definitely. Well, Paul, thanks again.
Yeah, thanks, Jack. It's been great being on here with you.
There is something that you need to be doing right now, and that is reading the Blockworks Daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks Daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.